So I'm excited for this one because I think it's super timely. Capital raising it's not easy. I think it's certainly a thing that people make it sound super easy, but there's a lot that goes into it. These two guys have raised a ton of capital. Bill Ham, he just got in this morning, flew in. He's super involved in the capital raising space. He's you can read his bio here. He's the COO of Broadwell Property Group. He has a ton of experience in owning property, managing, operating it throughout Southeast Wisconsin or Southeast U.S. Sorry. He's really involved in a lot. He works with the Jake and Gino program too. He does a ton there. So he's been on a lot of stages and is a really valuable resource we wanted to bring here to all you guys today. Mike, we got connected a little over a year ago. He's in Chicago, and he's been in real estate for a super long time. He has a really great story of just being involved in a lot of deals. I mean, so he's controlled over $325 million in real estate transactions. He's an author, he's a trainer, he's a public speaker, and he's involved in 2 multifamily funds. So both of these guys have a ton of experience on the capital raising, and I'm excited here to get into some questions. So to start it off, maybe each of you can give a little bit further introduction beyond that, maybe some stuff I didn't include here. You want to kick it off, Bill?
Sure. Yeah, absolutely. I've been in the real estate business 20 years now. Started off in 2005, early 2005. I was a pilot by trade, walked away from aviation with a duplex. My first 402 units actually accomplished with nothing but creative financing. And we'll talk about that in money raising. But so that was seller financing, lease options. And then I've done over 1,000 units since then. Yeah, I've raised a lot of money, done a lot of syndications, and it's a heck of a business. It's a good business, but it's a tough one. So, yeah, I'm good, Mike.
Okay, great. Thanks. Bill, nice to meet you.
Nice to meet you as well.
I've seen you around a little bit, heard about you, and
Thank you.
it's good to meet you. Brock, I think we met each other longer than a year ago.
Probably was.
Yeah, it's been a while. So I've been in the real estate space for 30 years. I started out, I had a general contracting business, and we were building about 25 room additions a year. And I can remember waking up one morning just going, I can't do this anymore. You know, as an entrepreneur, you do everything in the business, and I was doing everything plus still banging nails in the field. And just, you know, I was fortunate I had somebody that bought my business. I went in the real estate sales business. As a real estate agent, my first 9 months in the business, I sold 78 houses, went on to build a team selling 125 homes a year for about 12 years. And then in 2005, I went in the apartment business. And I always tell people, I say, I never just went into the apartment business. It was one of those things I had thought about for years. You know, there's a couple of large syndicators in the Chicago market that I watched, did some work for when I was in the construction business, and I understood 2 things. You raise private capital and you marry it with a great real estate deal. As long as everything goes well, you stay in the middle and everybody makes money. Like Bill said, though, it's not an easy business. So I scaled a 4,000 unit, $60 million portfolio in 5 markets in 30 months, vertically integrated a property management company managing 7,500 doors. And we were valued at about $100 million. 2008 rolled around and crashed and burned like so many of my friends. So today we're back building again. So.
That's right, only stronger. So the first thing I want to touch on is just to really take a step back and I guess talk about like capital raising as a whole, right? So the overview obviously is we're talking about, you know, you're raising money, syndication model. Everyone in the room is familiar with that. So let's take your example, like, or I guess specifically for you guys in your business, what sort of people are you bringing in as investors? Are you working with individual investors, or are you going out and going after like big institutional money? Because there's a big difference. Maybe we can touch on like what that difference is so people can decide like what makes the most sense for their business.
Yeah, I would say the majority of my investors are actual individuals. You know, jokingly, it's what I call millionaire panhandling, right? You're going around going, spare 50 grand, spare 100 grand. You're not. You're offering investments, by the way. And people keep kind of mentioning that, you know, are you afraid to ask for money? You're not asking for anything. You got to keep in mind that when you're raising money, you're bringing an opportunity to these people they wouldn't get otherwise. Right? You can't call up your stockbroker and say, hey, put me in some real estate deals. It doesn't work that way. These are private. So always remember, you're not hat in hand. You're not begging for money. That's not how this works. You've created a good opportunity, and if these people don't understand that, that might not be the investor for you. I have tried to work with a few larger groups, never could get through the paperwork. They wound up wanting to wrestle away a little too much control in that structure. So I've never worked with large groups. I've done all mine with smaller people.
So I like what you said, the panhandling piece, right? I work with a lot of individuals and they say, well, how do you ask people for money? You're borrowing money. I said, no, you're not borrowing money. It all becomes a mindset, right? You are helping other people create wealth for themselves. And as an investor or as a syndicator, what I like to do is create 3 buckets, cash flow, long-term wealth, and tax planning strategies for my investors. So like Bill, I do a lot of private individuals, both accredited and non-accredited investors. I have done some institutional money through insurance companies and a couple of family offices. But like Bill, I really like dealing with individual investors because you build a relationship with those people, and then those are the people that you watch them grow and you watch their finances grow, and they continue to invest with you in multiple deals.
Got it. Yeah, and I think you're certainly right, where it's like the trajectory is a lot of times you start, you're with the retail investors, $500,000, $100,000 checks, right? And it might make sense at a certain point where you start bringing in institutional money and it's $1 million checks, right? But not always, right? There's plenty of people that stake within that model because a lot of times these institutional family offices want to control the deal and they want to change everything in the deal. So that's tough. So let's talk about like just where we're at right now, right? Like in the market where it's tough right now, right? I think banks obviously are tightened up. We're going to talk about that on the financing panel. I mean, there's a lot of things moving against real estate right now where it makes it an interesting environment. But what is what sentiment are you seeing right now when it comes to capital raising? I'm not sure. I mean, you have some active deals going on right now, but like, is it hard right now to raise money, or like what stories are you having to kind of go through with investors to really prove long-term it's still going to be a great investment? Let's talk about that a little bit.
Yeah, so right now, there's been a time in history where you could, give a presentation and somebody wants to write you a check right now. And that's not the environment we're in today. It takes a lot longer. Anybody who's in the sales business knows that you have to make more than 1 or 2 follow-up calls to get a sale done. And so it takes more phone calls. It takes more explanation. There's a lot more questions. I get a lot of questions today based on the environment that I wouldn't typically get. Well, interest rates are too high. Well, when I'm doing a deal right now, we're assuming some small balance loans that are government, and the interest rate is 3.5%. So, you try to overcome that objection. People will come up with objections about markets. You overcome those objections. It takes a lot more explanation, and I want to say a lot more hand-holding today, but the end results are worth it.
Yeah, the only thing I think I would add to that really is yes, the market has gotten more difficult as far as raising capital is concerned, but it's kind of an irrelevant point because you still have to go out, you still have to meet people, they still have to have a relationship with you, they still have to know, like, and trust you, and that never changes. So don't worry about it. Just go out and network, meet people, build the relationships, and let those chips fall where they may. Worrying about the market and all this kind of stuff, there's nothing you can do about that. So there's really not any real reason to be that worried about that. I would just kind of, go out and take action and start networking and building relationships. Is it going to be tougher today? Absolutely, it is. And the one thing that I've seen, and maybe you probably don't know this because you have the experience, but we're seeing the lenders, and I'm sure y'all talk about this later, leaning more towards experienced operators. So if you are new to the business, what I would suggest is that you really start networking for partners that have some experience. Now, why would a partner join you if they have all this experience? You need to find a good deal. And that's the number one thing that these guys can teach you and we can teach you is how to find a good deal. That's the key, and it's not really been talked about yet. If you can find a good deal, raising the money is going to be a whole lot easier. I'm not saying easy, easier. If you can't find a good deal, raising the money is going to be damn near impossible. Right? So focus on finding a good deal. That is the one thing you can control today is deal finding, deal flow. So that's what I would focus on.
Yeah, I would maybe double down on that to say like it's not necessarily like within the syndication group, like it's not necessarily you doing all the work, right? You got to find the deal with the asset. A lot of times it's partnerships, and someone might be the asset manager finding the deals, and the other person raises the money, right? That's a lot of times what these dynamics come down to. So to go into that, like someone that wants to start building a network to raise money, like what sort of strategies, like what sort of things should they be thinking through to be going out and starting to source these investors, build out an investor list, you might say, like how do they, what's some strategies for them to do that?
So I work with a lot of coaching clients, and I teach my clients from day one, from the minute we get started, that you have to tell everybody what you're doing. You know, we walk into a room thinking that people know who we are or know what we do, but you actually have to go up to somebody, introduce yourself, and somebody asks you what you do, tell them what you do. Hey, I'm a real estate investor. I partner with individuals like you to help you create wealth, and we share in the profits with you. So you have to explain to people what you do. And as many times as you think that, you know, there's people in the room I know that I've met before, and when I tell them again what I do, they go, oh, that's right, you syndicate deals. So I'll be networking with somebody, and somebody will say, what do you do? I say, well, I'm the chief investment officer for a multifamily hedge fund, and we buy large apartment complexes in specific markets, and we partner with people just like you to share in the profits. You know, it's 11-second elevator pitch. Get your elevator pitch down. Build into everybody that you meet. Talk to them about what you do, and build a database. I think we have to act like farmers. So we have to plant a seed, water that seed, because the day's going to come that you'll want to harvest it.
Absolutely. Yeah, I think the advice I would give you if you're new and getting started, and I heard someone make this comment the other day, and I feel bad because now I'm going to quote them all the time. I don't remember who said it, but it's not who you know, it's who knows you. And I thought, oh man, that's the ticket, isn't it? Because you can go around and collect business cards all you will like, right? But that does not make a relationship. And so if you're new to this business, you're going to have to expose yourself to the world. You're going to have to build a brand and get your reputation out there somehow, right? Because just walking around and meeting people and getting business cards, that's not good enough, right? People are really going to have to know who you are. They're going to have to be comfortable with your brand, your reputation, things like that. So I think branding is a really, really big one. And I think you said earlier, what you said, you know, you can't fake it till you make it. Agree completely. You know, we're talking about credibility earlier, and he said, look, don't worry about that until you have. 1,000,000% agree with that. I think it was Justin said that. Don't fake it till you make it. Don't try and go out and create fake credibility and websites, all this kind of, you know, credibility and all this stuff. Just be honest. Use your education to lead to the credibility, right? So when people say, hey, you've never done this before, or you're new, own that. You're like, you're right, I am new. I've never done this before, but I'm working with these guys, this, that, and the other. And so use your education, and then somehow you're going to have to get out into the world and create branding. It's a little tough. I mean, social media is great, but what are you going to do or say on social media that gets people to pay attention to you, especially in a world where everybody's trying to say something on social media to get credibility? You know, so there's just a white noise of people trying to create credibility these days. So I wouldn't fake it, but you know, you're going to have to make something that exposes you out there. I would say start with a website and a CRM, and then just try and, you know, get leads and names in there. That's probably what you need to be doing right now.
And do you think, brings up a question, like people should start with trying to go online, right, and podcasts and social media and like bring investors in that way, or does it make more sense to go out and like call your friends and family, like people that already know and trust you? Is that doing both? Or like where should someone start?
Well, I would quickly answer that with going yes. All the above, right? When you're new to, what I always tell all my students is, when you're new to something, the answer is yes until proven to be no through experience. So when you're sitting here saying, well, should I do that? Yes. Should I try that? Yes. Should I try that? Yes. Try all of it. If it doesn't work, then stop doing it. But don't sit here and mentally co-sign your own BS and then not go take action because you talked yourself out of doing it. So that's a mistake. So should you be on social media? Absolutely. Should you be on webinars? Of course. On anything and everything you can possibly do. Show up at places like this? Absolutely. If you're not getting a result, then let's not do that, and we'll change it out for something else, right? But yeah, don't sit around and think, should I? The answer is yes, until you do it through experience.
Got it. Okay, so I wanted to kind of go into some real life examples, right? So we're going to talk about first the good, and then the bad. So let's go through a deal you've completed in the past, right? That you raised money for, it went great. Like, walk us through how that capital raising process went, and like the good one.
Did you take that one?
I'll go first. I'm going to talk about the first deal I ever did. So back in 2005, when I went in the syndication business, I said, okay, I'm going to go find an apartment building. And I went out, I started to look at some deals, and I found an 11-unit deal. And I thought, wow, this is great. And I put it under contract. And I was so excited that I put this thing under contract. Then it occurred to me that I need to raise money. How am I going to raise money? So what I did at that time was, and I'm going to date myself a little bit, I put in a newspaper in the classified sections, a little 3-line ad. I think it cost me $45. And I said, real estate investors wanted. And from that ad, I raised $700,000 over about a 6-month period. I don't think you could duplicate it today because of social media, and there's no newspapers out there anymore. But so I raised the money, we got that deal closed, but what I found out was that I believed everything the seller told me. So I listened to the sellers say, hey, all you have to do is put a new boiler on, put a roof on, update the units, redo the parking lot, fix the balconies. You'll be able to go ahead and get new tenants in and raise the rents. And I thought, wow, this is great. You know, what a great idea, you know, great business plan. Well, I did. I went in, I put a boiler in, I fixed the parking lot, I put a roof on, balconies. I got the same old tenants. The same demographics kept coming back, and they would trash the units, and I'd have to redo them. What I didn't do was I didn't know how to do the due diligence. So I didn't know how to do the early evaluation that you need to do on a property before you go to contract, and then after you go to contract, that due diligence, that research on the back end. But that was such a great learning experience for me, because I was able to sit down with my broker at that point and go, hey, we need to create a buying strategy. Let's create a buying strategy. And I put together this strategy that I really never have veered from again of the type of product that I buy. So.
Yeah, I would say on the easy money raising side, I probably have a more interesting story on the bad side. On the good side, yeah, I would say it was probably the best ones I've done, or when I had a smaller group of close people that I was working with, that I had good relationships prior to finding the deal. Because if once you've identified the asset, that's not when you want to start raising money. You're way late to the game if you're trying to raise money on a deal you have under contract, right? You might collect the money once you're under contract. Raising money starts long before that in relationships, in networking, in meeting people. And that'll lead me to my bad story, but yeah, you can't start meeting people and thinking that you're going to establish $1 million relationship with them in your due diligence window. In the amount of time that you have that property under contract, you're way late to the game if that's when you're starting the money raise process. So I would say that do that way early on.
I would agree.
Network.
Okay, let's go on to the bad one then.
Oh, easy, bad one. I lost $150,000 in a failed raise once. I had a large apartment complex in Atlanta, Georgia. This has been probably 7 or 8 years ago now. And I made the mistake of thinking that a stack of business cards meant a network. It does not. And so what I had done is really gone around a lot of these rooms and just gathering business cards, but I never followed up. I never established the relationship, and so I was just kind of lazy in that regard. And so I've got this big stack of business cards. I think I've accomplished something. So I go put this property under contract, start calling business cards. It didn't work out so well. So the one thing I'll tell you right now is that from verbal to cash is at least a 50% attrition rate, at least. And I'm going to go with maybe more like 60, 70%, right? So if you've got $1 million worth of people saying, yes, I'm interested, you probably got $300,000-400,000 in the bank at best, right? The attrition is heavy from verbal to cash. Everyone says yes to your face when you're talking to them, right? Everybody wants to invest. Everybody has money. Everything's great to everybody. But when you say, okay, write the check, send the wire, reality kicks in and you're going to have a big drop off. And so I didn't realize that. So I had just enough, network to get the deal done. The attrition kicks in and I fell short of the raise and wound up losing $150,000 in earnest money. So that's what we call tuition. Spent that. So no, I'm about $800,000 or so into my education if we consider losses and failures and things like that. So hey, point being, that sounds terrible, it sounds dramatic. I'm fine. He's fine, we're fine. Don't worry about it. You'll be fine. I made the money back on the next deal. In the short amount of time that it was going on, the world was collapsing. I mean, I thought I'm the laughing stock of the business. Everybody in Atlanta is like making fun of me right now. I'm the only guy that didn't close. I'm blacklisted. Hey, look, I wasn't that important. Nobody cared. They really didn't care. I just was not that important. You know, memories are short, money's green. You know, it's like I called up realtors the next day and like, hey, I heard about your problem. No problem. Let's look at another one. I wasn't blacklisted, you know, but in that moment of losing that money, man, I thought life and my career and everything was over and all this horrible stuff. It's not true. You'll be fine. It's not that big of a deal. Just don't stop. That's my key. Don't stop.
Yeah, I think we make those stories up in our own head, right?
Oh, I mean, you know, yeah, nobody cared. Nobody gave a damn about my problems. I thought, you know, everybody was on watching me. Nah, just not that important. Nope.
What about yours, Mike?
My bad one?
Yeah.
You don't want me to tell my real bad one, but, in December, well, let's see, October of 2021, we were just trying to get a 40-unit deal closed in Tampa, Florida. And we were about a week away from closing, and we got an email from Fannie, who said that they weren't going to fund our deal. We had a written approval from them and ready to go. And during that time, we had raised 90% of the money that we needed. About 60% of that was in the bank. And I thought, oh my God, we did something wrong, right? Well, I wound up being on a mastermind call later that day and found out that 6 other people on the mastermind got the same letter or same email from Fannie that we got. Fannie and Freddie had run out of money about October of 2021, which is typical for them. You know, they'll get a boatload of money at the beginning of the year. They'll run like racehorses and ultimately run out of money somewhere towards the end of the year, which didn't happen this year, which is interesting, right?
Which is published information, by the way.
Right.
Their annual budget is published. It's not secret info.
But there's still a bunch of money out there for both for the government agencies, and it's just because loans are a little bit harder to get done and interest rates are higher. So anyhow, we had to punt and not close on that deal in October, go out, scramble, we put a new loan in place. During putting that new loan in place, a bunch of investors pulled out of the deal, wanted their capital back, and then those soft commitments like Bill was talking about, people went and bought cars or decided to take a vacation. So all that money we thought that was there wasn't there. So we were short money to close. We had to go get a bridge loan, bring in a preferred equity into the capital stack, and then take them out by backfilling some of the equity after that. So that was probably one of the toughest ones I've done.
Nail biter.
I don't have much control over that with the bank. Okay, so let's go through like a little strategy here. So let's say, like you were saying, Bill, like 50% of the people that tell you yes, they're gonna be no. What can we do to improve that, right? So you go out and have a conversation. Hey, this is what I'm working on. I'm trying to find this deal. Can I count you in for 50K? You know, yeah, great. What do you do because the odds are you're not going to have the deal next week, right? There could be a 3-4 month gap before you actually get that deal. So what sort of things are you doing in between then to stay on their radar, stay in touch with them? What's the strategies there?
Yeah, follow up. That's your answer right there. Stay on the radar. Follow up. Let them know where the deal process is, and overraise, overfund. You know, and make it an urgency model. Hey, I need $1 million, but I'm talking to $5 million worth of people, and the first X amount of people to send a check, you know, that's in. So there's not a lot you can do, honestly. If there was some magic answer, I'd give it to you. And if you have one or somebody else has one, hey, I'm buying. Tell me, what is that magic answer? Because I haven't come to it. It's people. People do weird things, and you just got to know a whole lot of people and build relationships with a whole lot of people so that a certain amount of them hit. Because like you said, you know, it might be a yes today, but something has occurred with that individual in that amount of time that it becomes a no. But that doesn't mean a no forever. Just means a no on this deal. You don't throw them out of the database, you know, you just follow up with them on the next time. But large database, follow up, you keep everybody in process, and then take possession of the money as soon as you can. That would be my answer.
We try to get people funded right away. So I try to encourage my investors to complete their paperwork and to get their money transferred, and so it's in the bank. If it's in my bank, I have a better chance of holding on to it than if it stays in their bank. You know, I just had somebody this week who was going to fund into one of our deals, and never finished it. Her car broke down. Husband wanted her to go buy a new car. She went and bought a new car. Interest rates on the car were, 12, 15%. She said, I'm not financing it, used her cash to buy a new car. So, these things come up. And remember, we're dealing with people, everybody's human, overraise and get people to fund early.
Yeah, I mean, the best problem you can have is the deal
Yeah.
oversubscribes, right? That's what you
Right.
want is someone was 2 weeks late and they couldn't get in, and now they're the next deal. They're waiting for it. So beyond that, you close the deal, get all the money raised, great. Like what does like investor relations look like after that? Like, how do you keep investors informed on what's going on? Keep them involved in knowing what's going on. What does that look like for you guys' businesses?
Yeah, so we're very transparent. Once a month, our investors will get a newsletter. It'll basically update them about where we're at in capital improvements, operational changes, what we've done, where we're at occupancy-wise, how the KPIs, those key performance indicators. I'm a huge asset manager. I won't take my eye off the ball, so I'm always on the phone with property management or my construction crews, making sure that's getting done. And then I'm communicating that with my investors. So once a month, they get an investor newsletter. Once a quarter, we do a Zoom call, an investor Zoom call, and update them. And I tell my investors all the time, hey, if you need something, reach out to me, call me. If you want to see P&Ls or financial statements, let us know. We'll get those to you. So.
Almost the exact same answer. Yeah, quarterly distributions on capital with a quarterly conference call, monthly newsletter with an update and T12 financials, and that's really literally it. Something I haven't done yet, I don't know if you all have yet or not, is using any of the investment portals, the investor portals. I haven't done that yet, but I've sold everything in my portfolio. The next deal, that's what we're gonna start doing, is running more of these software portals that bring in the investors in. I just haven't done that yet. There's a lot of them out there. But yeah, we're gonna do that going forward. But still, same thing, monthly sort of touch, email, say, hey, these are the books for the month, quarterly distribution. I have found if the property is running well, they don't wanna talk to you. They don't care. They don't wanna waste their time getting on some conference call to hear about how well the property's doing. So we find that when our deals are going well and we've raised money from the right people, you almost never hear from them. And they might jump on the call here and there, and it's just not that big of a deal. When things are going well. Now things are going not so well, you'll have more of them show up on the call, but as long as you're sending out checks, it's usually pretty straightforward.
So I have to laugh at what you said, right? So we use InvestNext as our investor portal. And it's kind of funny because in my past life, we never did.
Yeah,
we took a check, we send documents to people, they send them back, they write us a check. Today everything's done electronically. We just had an investor who we sent a couple of quarterly distributions to him, and he never got them. And for some reason, his bank account wasn't connected, and he said, could you send us a check? And I said to my partner, I said, do we even have any checks?
Have checks.
So,
Yeah, I agree.
so it's kind of funny how the world's changed.
Wire it to you.
It's easy. It makes it easier, though, because then you're not dealing with a bunch of paperwork.
Yeah, the investor portals do make it easier. What's if you look at over the years, right? There's probably a lot of learning lessons you've had over the years. But there's one learning lesson you could specifically highlight to people in the audience of like, this is something, make sure you're looking out for. Don't do this or do this. What's one thing you could say to everyone for advice?
Are we strictly talking about raising money or just in general of real estate all over the board? Which let's narrow that one down, because I would say the general comment, well, I guess on raising money, again, my comment, same I've always made, is just know lots and lots of people. That's the one thing. Real estate in general, I would say the one thing is quality of asset, right? If you can buy a good property in a good location with a good mortgage, you've mitigated probably 98% of the risk in the business, right? I mean, it's really that simple. Good asset, good location, decent loan. You've got holding power and you've got staying power, right? It's when you go out and you get interest-only loans justifying the purchase price, or you're using debt to kind of justify overpaying, and you're doing all these little crazy things. That's where you get in trouble, right? Good location, good asset, that will solve the majority of your problems. And cash flow is very important. But it is never an argument between cash flow or appreciation. You know, I hear people say this, think, oh, cash flows or appreciation is nice to have. You know, I buy for cash flow. If anybody's ever said that, you're wrong. You know, if you said the other, hey, it's all about cash flow, you're also wrong. You have to have both. Look, I've gone into I have cash flowed into foreclosure. True story, right? Just because you're cash flowing doesn't mean the loan doesn't come due. The loan comes due. And if your value is off, you're going to have a hard time exiting that loan. So don't let anybody ever tell you it's all about cash flow or it's all about, no, it's all about running your business. And your business is on the asset and the operations, both. If you have those, you're totally good. If you violate those fundamentals, you're gambling. And that's a hit and a miss. That's my general advice, is location and asset and loan.
I got a couple. First one is, I always tell people, I say, don't grow too fast. This is a marathon, it's not a sprint. You know, you don't have to go out and buy 1,000 units this year. You know, start with 5, start with 50, wherever you're comfortable. And, you know, somebody said earlier, syndicate a duplex. And, you know, learn how to do the business and grow incrementally. The next thing is, don't over leverage. You know, I owned $60 million worth of real estate at 85% loan to value prior to 2008. And I always say, I don't know who was worse, me for taking the money or the banks for giving it to me, but that's brain damage. You shouldn't be in a deal unless you're about 65% loan to value. And then the third thing is always pay attention to the details. You know, asset manage the asset. You know, don't just trust to the property management team or your on-site staff. Asset manage the asset and watch those key performance indicators.
Yeah, that loan to value is huge. Again, that's kind of what I said. If you're using debt to justify a deal, you're making a mistake. That's a bad idea. You know, I can get 83% leverage, therefore don't do that. Be very, very careful. And a lot of times people, like you say, they think the more debt, the more leverage and all that's better. Not necessarily. Not for staying power, not for being in the business more than about 2 years. You need to get the right loan. So yeah, absolutely on that one.
And on that topic, one of the learning lessons we had in our first deal was raising more money than that. You know, if you need $1 million to get the deal closed, like, you need to raise more money, right? Because stuff's going to go wrong. You build out a 10-year pro forma, there's going to be a couple things that go wrong you didn't account for. So, like, what are your thoughts on, or I guess approach to, like, when you look at, like, how much extra money, aside from, like, rehabs and all that stuff, like, the importance of raising extra capital for the stuff that you didn't account for going wrong?
Yeah, so, you know, it starts with CapEx, because you always underestimate CapEx, right? Because you never know where the termites are, you never know where the mold in the subfloor is, you never know how many floors around toilets are rotted until you really get in there and you start doing demo and ripping things apart. So always overestimate your construction costs, 10 to 15%. So I always take my total and I add 10% to it right away. And then I add my construction management cost on top of that, because you want to make sure you have enough capital. So for me, that's a big place. And then I always like to have a little bit of extra money. So I may inflate some of my numbers, like on legal costs and closing costs and how much I need for startup costs. I do that for my protection, but also for my investors' protection. And then what I'll do is I'll finalize my underwriting model, and then I create a working underwriting model. So if my legal fees come in less, I give that money back to the deal, and I take it off. And then I show, you know, the progression of the returns then. So try to make it, you know, better for everybody involved.
Yeah, I think as Mike is kind of describing here, it's hard to say. You know, people want, because I get asked that all the time, well, how much should I just hold in reserves? Well, what deal? What's the condition? What area, you know, what's your loan look like? You can't just go, oh, it's 5% all the time, just hold 5%, you're good. No, it's not like that. You know, CapEx is huge conversation. We go on all weekend about just CapEx. And that's my comment about flight to quality. Be careful about stuff built a little older than about 1980. You better really pop the hood on those properties, especially in plumbing and subflooring and the things you've hit. Really be careful about older buildings, because what you're discussing is a cost basis model. What you buy it for, what you got to put into it still needs to be less than after repair value, just like a house, right? Just like flipping anything. And these older buildings are getting hard to predict that CapEx. And that's where the reserves and how much should we hold aside for this old building, it's really getting hard to predict. If you're talking about something built in 2005, that's pretty predictable. That's not that hard. Hold some money for some, maybe a mortgage reserves or something like that. Property built in 1963. Yeah, you probably want several months worth of operating reserves plus at least 20% over anything you think you need for CapEx, at least. And that's where I think a lot of the older buildings are just getting very unpredictable, a little tougher to deal with.
You can make money in them.
Oh, you can. I've done a lot of them.
You can make money in them, and and it might not be a home run, but and my philosophy is if I can hit a single every time at bat, every once in a while I'll hit a home run or a triple. But those old, I always tell people, I say, no matter what you do to a property, if it's a 1960s product, when you're done, it's still a 1960s product. You can't change that.
That's absolutely right. Yeah, as long as you're buying it right, and that's the key, as long as you're buying it right. If you're going in and buying a 1960-something product at a 4 cap, that's not a 4 cap, that's a foreclosure, right? I'm just telling you, you can't get away with that, And we've seen that. We've seen that in some of these markets, like Atlanta, where I'm from. An A is a 5 cap and a C negative minus is a 5.5 cap. And you're going, there's no spread between the A and the C here. That's not a risk-adjusted reward. So I think the affordable housing market has had cap rates artificially compressed through over syndication, since we're talking about syndication this weekend. So that's where I'm kind of saying, hey, I think we got a little bubble going on in the C space, the affordable housing. Be careful in there. Because I think when people start to sober up on how much work is really needed to go into these properties, the only thing you can do is bring the value down to make the cost basis work.
Can I make a couple of comments?
Yeah, let's just chat. Forget you. Very good, thanks.
I couldn't agree with you more, and I think there's a couple other fundamentals that are going on in the market right now. First of all, you've got a couple of $1 trillion in private equity in the market in the multifamily space, right? So that's inflated the market. Then over the last couple of years, we had everybody and their brother and their cousin who said, wow, multifamily's easy because you had the wind at your back. Yeah. And Warren Buffett said that when the tide goes out, you're going to see who's swimming naked, right? Yeah. And that's what we're seeing. I think the multifamily space has thinned out a lot, and a lot of people who were great syndicators or thought they were great syndicators have gone now and they're doing car washes and self-storage and industrial buildings because it's easier, because the cap rates are different. So right now, this business, if you can thrive in this environment, in this business right now, when the wind is at your back, you're going to do exceptionally well. And I encourage people today, get in the business now, get in this multifamily space now, because as we come out of this, out of the valley and start to go to the top of the mountain again, because remember, these are cycles, and we're a couple years into the down cycle now. So just know where you're at on those points, and as we start to cycle back out of this, the wind will be at your back, the wind will be at your investors' back, and you'll do real well. You'll look like a hero. But there's operators today that are kind of struggling because the wind was at their back and they really didn't know what they were doing, and now all of a sudden they have to figure out what they're doing.
Yeah, I've not been that excited about multifamily over the last 2 or 3 years because of the pricing and stuff. I'm thrilled about multifamily going forward because I think we're going to have a big shift and a big downturn, and I think it's going to be a really good opportunity for people to get in with the right network, with the right people, the right relationships. Yeah, it's going to be a little tougher to just walk over to Bank of Anywhere and just get a loan and walk out with a bunch of money to buy multifamily. That's going to slow down some, but I think that will also cause a tremendous amount of buying opportunity for the right people with the right partnerships, and that's why we go back to network. If you can bring a deal to people like us, we would probably join you if you have that good deal, But if you don't have a good deal, you probably don't bring any value to us. We don't need you to underwrite. We don't need you to call realtors for us and take out the trash. And I get people call me up all the time. Hey, can I come be your, apprentice and follow you around and do your laundry? No, I don't need any of that stuff. I'm good. No, bring me a deal. We'll do business, right? But I'm not into that sort of free mentorship. And you get that a lot. And so, but if you find a good deal, there's always people like us that are really ready to do business with you. You just have to bring some value. My opinion.
Can I say something?
Good.
You're killing me. So, yeah, I don't do a lot of the free mentorship, but I have to tell a story. So I had a young guy call me about a year and a half ago. And I got connected with him prior to that through a friend who called me on the phone and said, hey, I would like you to talk to this guy. He's trying to get in the multifamily business. So we spent about a half hour on the phone, never heard from him again. 3 months later, he finds me on LinkedIn, calls me up, says, hey, I'd like to underwrite for you. I said, yeah, okay, everybody does that, right? So I said, I'll tell you what, I'll send you my tool. If you can figure out my underwriting tool, we'll have a conversation. Well, he called me back the next morning. I said, you blew it up, didn't you? He goes, no, I figured it out. I said, you did? I said, shit, nobody ever figures that out. So we went through it, and he's been underwriting for me ever since.
Excellent.
He's a young guy, 21 years old. He's a finance major at TCU. We have a great relationship, and he sources deals, builds relationships, he raises capital, and I've kind of taught him the business. But the point I'm trying to make is figure out, there's a lot of things to do in this business. Figure out what you are really good at. I think everybody needs to know how to raise capital, how to underwrite, and how to build relationships. Those are the three most important things in this business. You might not do the underwriting, but you have to be able to raise capital. And you have to, as part of raising capital, you have to understand the numbers, so you have to be able to read the underwriting. But figure out what you're good at, and then go build a team based on the things you're not good at. Find people that are good at those other things. I have a partner that is my right arm, and without her, I wouldn't exist today, because she does all the stuff that I just don't have the brain power to do. I can't sit down and read an LLC agreement or a PPM because I'm asleep by page 3 and have to start over again. It doesn't make sense. They're boring to me. But she goes through that, and we, all those types of things, so.
I would agree. I think understand, that's another question here. So how important is it for someone they decide, I'm gonna go out, I'm gonna be the capital raiser, to understand the back end of the numbers, right? You don't have to necessarily be a spreadsheet wizard, but like, how important is it to understand the numbers to be able to go out and raise capital?
I'd say somebody better understand them. I mean, maybe you don't completely understand, but somebody on your team better understand those numbers. You know what I mean? Because that's incredibly important. If you're talking about, being a fiduciary, you're taking responsibility for hundreds of thousands or millions of dollars of somebody's money. Somebody better damn know the numbers. I mean, maybe you don't know the number, whatever, but somebody better. And if you're the one raising the money, you better know the numbers well enough to explain them and answer questions and field concerns. Because if I'm sitting down talking to an investor, and the investor says, well, okay, you're showing me this rate of return every year. Where'd you get that number? Where does this return come from? And I go, I don't know. We're going to raise the rent a lot, and then it'll make a lot of money. That's not a good sales pitch. So you need to be able to kind of really field objections, know your deal, know what's going on. No, you might not be a spreadsheet wizard, like I said, but I would say it's like it's sales. Raising money is sales. You need to know your product well enough to be able to sell it, in my opinion.
Yeah, 100%. You have to know the numbers. You might not have to understand all of the fundamentals around it, but you have to be able to communicate the returns to the investors and where they're coming from. Because we're going to put this much capital improvement in, we're going to be able to, we're going to get a return from the renovation of X. We're going to be able to increase the cash flow X because this is happening, So you need to be able to communicate that to the people you're raising capital from.
Yeah, absolutely.
Yeah, I would agree. If an investor asks, how did you get to that number, and you can't explain it, it's
Yeah.
really hard to come back from that.
But
justify it.
Don't ever be afraid to say, I'm not quite clear, but let me go find the answer and I'll get back to you. So don't ever feel like you have to make up an answer. Don't ever lie, and make sure that you go get the right answer from whoever did the underwriting or whoever you're involved with, and then communicate that back to your
'cause
potential investor.
You're going to have to justify some of those numbers. I have people bringing me deals where they're showing rent growth at 25% for the next 3 years in a row. And it's a great deal. And I'm going, yeah, okay, I bet it is. I mean, but justify to me 25% rent growth for the next 3 years in a row. You can't do it, right? It's not happening. Nowhere in America is getting that kind of rent growth. So it's that kind of stuff where you're going to have an investor go, hey, great, I like you, trust you. Explain the numbers, and if you've got made up numbers, like a lot of this stuff, yeah, you're going to get called out on that, and you just need to justify the numbers. And if I say to you, well, hey, 25% rent growth for 3 years in a row seems improbable to me. I'm not saying impossible. I'm just saying that seems like a low probability. So explain to me where you're going to get this. Now, if you've got a great answer, I'll listen. You're not going to have one, but I mean, that's what you got to do. You got to be able to justify your business model to the investor, or they won't invest.
So, you got to get the data, right? So in building relationships, make sure that you build a relationship in whatever deal you're doing, whatever market you're in. Make sure you have a good relationship with the commercial broker. Pull a CoStar report. Get that data. That's your baseline data. If you have a relationship with somebody who does other larger deals, I have a great friend. We've been friends for years. I can pick up and call his underwriter, and they'll send me data from 3 or 4 different sources, and nobody's reflecting 25% rent growth today or
crazy.
projected, right? So I mean, you know the numbers in those markets.
Right, because you can put that in front of anybody, and it's going to show a great deal on the macro numbers. But if you look at what created those macro numbers, it's garbage, and that's where you're going to get in trouble.
I agree. All right, we got a couple minutes here. I'm going to open it up to anyone in the audience that wants to ask some questions. So feel free to raise your hand, shout them out.
Not all at once.
Hey, Mike.
Hey.
Would you be willing to touch a little bit more on some of the new construction projects you have going at the moment?
We have one new construction project. We're building a 176 unit Class B product in Casa Grande, Arizona. It's just outside of Phoenix. That market is growing pretty immensely right now because all these people work in Phoenix, but they can't afford to live there. So they need to live somewhere else. So the suburban market outside of Phoenix is growing. The fundamentals around the deal are pretty strong. We're partnered with a great developer who's doing the construction. We'll be out of the ground going vertically this fall. So,
Congrats.
thanks. That's the only new. I'm not a big new development guy. I like existing product and redeveloping existing product. But this happened to be a coaching client of mine that wanted to partner on this deal, so we did.
David Janelle with Wire Capital, affordable housing developer. Question I had was, how long do you typically hold investors' money until you find a funded deal?
Until you find the deal, is that what you're asking?
Yeah, find or fund the deal.
Well, what you're asking is capital drag. That's what that's called. How long are you holding capital that's not being deployed and creating a return until deployment? That's called capital drag. And I keep mine to a 0. So I don't take possession of investors' money until I am literally funding the deal. So a few weeks at most, right? So I've got my PPM together. I've got all the paperwork together. I'm coming to you. I'm going, here's the document. Hey, we're going to closing in a few weeks. First come, first serve. Send me the money. And then I'm going to have your money in that asset within probably 30 days or 45 days. So I don't run funds. So I'm not going around gathering capital, pooling it into a fund to be spent someday in the future, right? I don't do that. So I don't have much capital drag at all, even if you do a different model.
Yeah, I think the best time to raise capital is when you don't have a deal and in between deals, but you're not taking that money in.
Okay. There you go.
When I put a deal under contract, that's when I start to raise and actually have my investors fund their account. Now, the thing that's different in today's market, and you may agree with this or not, but interest rates are higher today in a money market account where you could actually take investors' money and put it in another account, get a better interest rate. You know, a year and a half ago when interest rates were under 1%, it didn't make sense. But today with interest rates being higher, so moving forward, as long as interest rates stay up, we'll fund money and then just put it in an account. I've seen guys in the past pay out 3% on that money. But if it's not in the deal, don't do it and don't promise it.
Kurt?
Yeah, I'm Kurt. I'm in the mid-market apartment space, like 8 to 50 units. I don't do any One of the challenges that I face is that when I'm doing my planning, underwriting to purchase something, it literally never goes according to like plan. It just never does. Sometimes it's way better. Sometimes it's not what I thought. Sometimes it's way different than I thought in a good way. How is your plan, consistent generally with your outcome? And what do you do when things come up, hiccups, things like the Fannie and Freddie loan? Obviously, that's an extreme one. But how much do you go with your exact plan? How much do they deviate, and what do you do with your investors when those things happen?
Yeah, go for that one, because I'm not sure how I'm gonna answer that. Yeah.
So if you, one of the best lines I ever heard was, if you want to make God laugh, tell him your plans, because plans always change, right? So I don't care how well I write a business plan, something along the way is going to change. I would estimate, $12,000 on a rehab, but then I get in this unit and there were termites, or the floor fell through and it cost me $15,000. So, things are going to change along the way. I like to see positive change when I can. I underwrote a deal where the going-in rents on a two-bedroom were $950, and I fought with my partner. I thought we could raise the rents to $1,250. He said $1,150 if we were lucky, and we argued back and forth, closed the deal. I'm renting units at $1,400 and just had a partner call this week thinking if we would put granite in the kitchens, we'd probably get $1,500. So plans change, but they can go either way. So I don't know if that answers it for you. You've got to be able to pivot and change, when those situations come up.
Yeah, I agree. I don't know how else really to answer that other than, build your plan on as accurate data as you can and have your predictions as conservative as you can, and you will cut down on variables in the plan. It's when you go in there and start what I call pencil whipping deals. You go in there and you go, oh, well, the deal sucks, so I'll just say 25% rent growth. Okay, there you go. There's where you're gonna have a problem in your plan. It's when you're making stuff up, or you're making up things to justify things that you want to occur. That's where you get in trouble with plans, when your plan is just a co-signing of your own BS. That's when a plan goes wrong. I think as long as you're paying attention to the math, the market, what's happened, and you're projecting reasonably forward, you're gonna cut down on the variables in your plan. But there's always gonna be some. Yeah.
Do you get, as a follow-up question, do you get investor pushback if, let's say your plan is 18 months to do this whole project, and it's 24 months, or it's supposed to be 2 years, but it's a 4-year, and they want their money back, and you're like, hey, you guys said 2 years, and now it's 3 years. Are you getting investor pushback?
Yeah, my deals are all 3, 5, 7 years. So,
That's where I was going.
if you're going into a multifamily deal thinking you're in and out in 18 months, you're kidding yourself and your investors. Your 18-month projection, and I model my construction and my operation, it takes you 3 months to figure out where the dead bodies are buried before you can, even get your arms around it and find some of the secrets that you need to uncover, even if you keep existing staff on a property. So you have to project longer up front.
Yeah, I was going to have to kind of mimic that comment, and I don't mean to be rude with this answer, but I don't think you're going to get that kind of answer out of an experienced syndicator. Guys like us who know what we're doing, we're never going to go in there and tell somebody they're getting their money back in 18 or 24 months. Or anything. That's the first thing I was thinking was I would never tell somebody that to begin with, right? No, right, exactly. But it's a great example because so many people have done that over the last couple of years. The Burr model. Hey, we're gonna buy it, renovate it, refi, pull all of our money out, give you all your money back in 18 months, and then everybody's getting infinite rate of return. And now because the rates have gone up, that's where I think we're about to see a spill in the market, which is gonna create a great opportunity for a lot of us to buy. But it's people who have made that mistake right there of not understanding the time and the length that it takes to get a deal done and to turn and to refi and all that. So I think people that do that, not ask that question, but get into that model are typically inexperienced. Because the more experienced operator is never going to find themselves in that situation, because we would never tell anybody an underperforming time frame. As a matter of fact, we're probably going to go the opposite and say, hey, it's going to take 4 years, knowing it's going to take 2. We would never say it's going to take 2 and then oops, it's 4. I've never had that happen, and I have never had anyone want their money back on a deal that was making money. So I kind of put it like that, right? If our time frame went longer, most of the times they don't care because we've been cash flow and we've been doing other things, right? So that's not ever been an issue of mine either. But I think it is a problem where people have been way more speculative lately, and betting on more of the Burr model, which works great in a upmarket cycle and then stops working when the cycle turns down. And so I'll talk about that in my next lecture, but you have to kind of understand market cycles. You can't always do the same thing forever and expect to be successful forever. You have to change the model with the market, right?
Sweet. All right, well, let's give it up for these guys.
Yep.